So now we're going to turn to the U.S. and look at some of the things that are happening from the U.S. perspective, from the Fed level. And some of the data came in pretty good, some of it a bit lackluster. We want to balance that out. But we first want to look at those total assets that the Fed has in general. So when you look at it, remember, we wanted to get down to Bernanke's 2010 target of under $1 trillion in total assets at the Fed level. You can see that we're still at about 8.5 trillion. So a bit far away from our target when you think about the tightening. And remember, everyone was talking about QT. QT is still going to happen. Here we are. And we started, and then you had the banking crisis, and you had some of that money go back in, and now it's come back out. So we've taken back all of the stimulus that went in during Silicon Valley Bank, all of the different backstops. But again, it's not getting much better. So especially when we start looking at reverse repo, the RRP, it's still over $2 trillion. There's still a significant amount of liquidity that's in the market that has to come out. Again, very hard to say that the Fed has done too much because, again, they haven't even really started, which is something that we continue to highlight in general. Which is why when you start looking at the implied changes, the usage of the Fed discount window and bank term funding program has continued to creep higher over the past couple of weeks. And it's part of the reason of why we don't think we're out of the danger zone when you start looking at banking and you start looking at the liquidity side for some of these banks because they've mismanaged their accounts. They've mismanaged, not all of them obviously, but some of them have mismanaged the way they're doing deposits, the availability for cash. So then when you look at the U.S. market implied changes in the overrate, when you look at that June 18th, again, you see it continuing to creep higher, which is what we continue to see as kind of the normal trajectory of at least one or two rate hikes more. Likely one is a definite. The second one will be more data dependent. We likely will get a bit of a skip, if you will, in August, and then it's going to be a matter of what do things look like going into the end of the year, because the hope is that inflation really starts to drop off when you start looking at the September onwards, and we're a bit more hesitant on the likelihood of that playing out. So now when we start looking at some of the leading indicators, non-manufacturing index from Philly unchanged at negative 16.6 in June. New orders reversed sharply back into contraction. Full and part-time employment fell into contraction. Work week fell into contraction, and prices paid continued to decline. Still in expansion, but again, still coming down. So this is a problem when you start looking at the service side. Now, it's important to appreciate that services has been really the piece holding us up. And it's not just in the U.S. It's been playing out everywhere where manufacturing is already in contraction, but you're starting to see the service side, staying elevated, but now starting to show those cracks, especially when you start looking at sales. New orders is now in contraction, sales in contraction. These are big problems when you start factoring in what does the future look like and how is that going to continue to propagate. Prices paid, you can see here coming much lower, back in kind of that normal range that we've seen. So again, it's good to see that slowdown in inflation, but by no means is it negative, showing deflation. Prices received, on the other hand, had a nice drop. Now, there's two sides to this, because prices paid is showing you what they're paying, but prices received coming down, they're issuing sales. They're starting to see that problem on the sales front. So what do you have to do? You have to try to compete. And this is that margin compression that we're seeing at the balance sheet level when you look at earnings, when you look at some of these pressure points, and why we see some of these underlying issues. Now, this is more stagnation than it is deflation, but something to watch nonetheless. Now, the average age of U.S. vehicles continues to creep higher. For those that think that EVs are just going to come save the world, again, as rates go up, as cost of just, I don't know if you've looked or, now this is going to be a slight anecdote, but anytime there's a new car that I see on a commercial, I always look it up and try to build it because I think it's fun just building cars, building trucks, seeing what different, is there some new, option that I've never seen before, but it also gives you an idea of pricing. And if anybody has seen prices come down, I'd love to know what car you're looking at because they keep going up, which again is going to keep people in the cars that they have now longer and longer to avoid some of these rate increases. So now when we look at the share of U.S. rental movers, again, people who have their cars, a lot of people have moved during COVID. They moved from the apartments to the homes. They got a vehicle in order to be able to get away. But share of U.S. rental movers by reason to form own households is still continuing to be a focal point. Want a more desirable neighborhood, is something that really crept up during that COVID period. To be closer to family, again, trying to offset some of those costs. Change in household family size, something there in general. But one of the big components is that other piece. And it's interesting because when you look at to reduce housing costs, that's flipping now the other way, which is going to be interesting because we saw people going from renting to home ownership. But now as rents have come down, mortgage rates stay elevated, that's going to be an interesting one because, and we'll go through the data in a moment, but there is a huge amount of 5+ units coming online because that's the easiest way to defer cost if you're a builder is just spread it across more people. So there are a lot of units coming online. So that's going to be an interesting one to see how that kind of changes the landscape in general because mobility rates have been in a long-term decline. And that's not something that has changed because Americans are less willing to move per the latest update from the Census Bureau through 21. American mobility rate fell to a record low. But look at the movements in general. And this is why when we start looking at the trend of gasoline demand, the trend of just activity, it's moving in a slower pace in terms of where things are, in terms of what people are willing to do. And as you get this contraction further on the consumer, pressure on spending, credit cards, again, that's only going to contract a bit more, keeping a lid on some things. In year-on-year terms, nominal retail sales growth bounced slightly in May from 1.2% to 1.6%, still in slowdown mode relative to prior years, but still in positive territory. But look at the trajectory. And again, the rate of change will flatline, but we do believe that we will be in negative territory within a very short period of time. Consumer expectations for an increase in unemployment rate next year remains very high off recent peaks. But again, you're seeing that going back up. And now with the commentary from the Fed today, you're continuing to see it's like, look, rates are going back up. The labor market is still too tight. You're still seeing some things moving up in general, and that's going to keep a problem on things across the board. University of Michigan interest rates during the next year, again, moving back up. June update for University of Michigan. Consumer sentiment shows 13% of respondents expect interest rates to go down next year, highest share since December 2020. And that's where it's like interest rates will come down. But the question is, it's unlikely in our opinion. This is some of the because the Fed skipped or paused, however you want to describe it, there's an expectation now that, it's like, rates are going to go down. It's like, no, that is not the case, which is why some of the consumer numbers you have to take with a grain of salt. Yeah, they're good to follow, as we always do. But remember, they're going to move around based on what they're hearing in the news. So here, when we look at the latest update to University of Michigan, the consumer sentiment shows buying conditions for household durable goods improved to the best since August 21. Conditions for autos and houses not yet recovering to the same degree. But go back to 1978 and you can see we're still at a very low level. And now it's hard to continuously come down. You get some of this bounce, but again, it's just going to go sideways. So it's not that people are going to fly out and start buying things. It's just that people, are in a position where they're not as problematic as they were, but it doesn't mean that they're going to go get active, especially when you start looking at other metrics showing the year ahead inflation expectations. And again, this is still showing something close to 3%. Now, It's something that we still believe will be higher than 3%, but you're getting an idea going back through 2020, 2012, we're still very elevated, and they want to make this come true. They want us to be back at 2%, and that's only going to be achieved with another rate hike. And again, keeping that elevated for a long period of time, which will pull down some of these consumer expectations. 1 year inflation expectation fell to that 3.1%. But again, that's something because the Fed skipped. When the Fed raises, I guarantee you that will go back up. It's just going to be something to watch. Consumer sentiment came in at 63.9 versus 60. Expectations came in better at 61.3. But again, it's still at levels that we had during different recessions and different slowdowns. So it's not that things are going to keep getting worse. It's just they're not as bad as they were. But one of the things that we've said is we're going to get to a point and then go sideways because we're not going to get this 5-10% U.S. GDP slowdown. It's going to be that slow creep of negative 0.5, negative 1% growth. University of Michigan current financial situation versus 5 years ago, continuing to fall. University of Michigan buying conditions for large household durables still very low. So again, people still see their financial situation getting worse versus 5 years ago. And that, again, is going to drive some of the bigger purchases that are being made, some of the bigger means of borrowing that is going to show that slowdown. Manufacturing trade inventory versus sales ratio unchanged from March to April at 1.4, still up considerably from a year ago, but not elevated relative to history. So just an interesting one to watch. April business inventory came in at 0.2 versus the estimate of 0.2, slightly below longer term average, but out of recessionary territory at the moment. But again, inventories moving back up as people just aren't buying as much, and you're just going to see those inventories continue to climb. Now, this is going to be an important one because this is more of a leading indicator showing that latest, Deloitte CFO survey shows hiring expectations have declined. Median growth rate for annual payroll has fallen to 0%. Less than half of CFOs expect employment at their firm to expand over the coming year, unseen since the depths of the pandemic in 2020. So again, you're seeing some of these views that, you're going to get that contraction. And as you see, again, rates go up, borrowing slow down, companies have to start tightening their belts, and that just means that they're going to see less and less employment. Trend and outlook is for weaker retail sales. When you look at retail sales versus the control groups, the bank's willingness to make consumer loans continues to push lower. And that's why when you look at retail sales, they're going to get weaker, but you're going to see that manufacturing inventory to sales ratio, again, that's going to get pushed back up as we see just inventories increasing, sales declining, and that's going to be a bigger problem, especially when you start looking at how the trend continues to move. Now, when we start looking at homes, it's important to appreciate that the data from Redfin shows that roughly 4 in 5 homeowners with mortgages have an interest rate that's below 5%. Nearly 1 in 5 have rates below 3%. 80% of likely home sellers say they would feel more urgency to sell if rates were to drop to 3% or lower. Because why would you take a home that you like that has, let's call it, 3.5% mortgage, to sell it, to buy a home that still hasn't really come down in price at a rate that is probably closer to 6.5%. So you'd almost double your interest expense for what? How much additional room can you buy? And the likelihood is not much. So you're not going to get a bigger home. You're not going to get a better rate. If anything, you're only going to move if you have to, which is why we're seeing the volume of inventory shrink, because you just there's no reason to sell. And this is what we call those golden handcuffs, because a lot of people can afford their current mortgage, but their equity has come down. So what is the impetus for me to sell? Now, housing starts have started to come back up. Building permits have gotten better. Realistically, you've had some labor costs come down a bit. I'm by no means saying they're back to normal. You've seen some input costs get better. You have supply side delays that have all but diminished to back to normal. And so you're starting to see some opportunities to come back into the market, especially with some of those building permits. But it's not all just one unit housing. It's multi-unit housing. So it's not like you're going to get a lot of these single family homes. It's all 5+ units because the costs are still high. Like I said, labor costs may have come down a bit. They're not back to normal. You've had some input costs that have come down. It doesn't mean they're back to normal. So it doesn't really make sense to build as many 1-unit homes, but 5+ unit, absolutely. Rents are still elevated. You still have more people that are looking to move into different areas. This becomes an opportunity to build and diversify. Now, when you look at builder sentiment, slightly better. When you look at the survey of 51, came in at 55. Expected sales also getting better over the next 6 months because a lot of these home builders are doing self-financing. They're giving mortgages. They're letting people borrow, and just because it's easier for them and they can get better rates and they can undercut what the bank is offering. So again, that's providing a bit of this sentiment increase. When you look at new privately owned housing units under construction, single family, you get an idea that we're still on the downward trend, but 5 units or more we're well above where we were in 73. So when you look at it in general, we have now surpassed the 1970s. And remember what happened after the 70s. When you start looking at the savings and loan crisis, when you look at all of the issues in the 80s, a lot of that is because you had this shortage that then was quickly, and quickly is obviously relative, inundated with supply, which is why we'll see some of this again drop back out in general. So it's kind of that balancing act in terms of the opportunities. Monthly new lease asking rents continuing to drift lower. Through May, the number of multifamily housing units under construction rose again and is now tied for a record in 1973. Now, again, it's just pointing to that back and forth. You're getting some of those multifamily units under construction. It continues to be a benefit, but it's at the same time you have rents coming down because as those units come to market, rents will get more and more competitive, bringing that down. And again, as you have looking at this and saying, okay, well, I can rent or I can buy something. Well, mortgage rates are crazy, so I'm not going to buy as much. I'm going to rent, which again is going to absorb some of this and relieve some of the pressure on some of these home prices, which is why we do see those home prices continuing to fall. Now, private housing unit starts, month of May, housing starts soared to 21.7% month on month versus the estimate of negative 0.1. Building permits came in at 5.2% versus the estimate of 0.6. So again, all positive when you're looking at some of that, addressing some of those supply shortfalls. And then the sentiment in home builders up from June. Prospective buyer traffic component has seen a relatively slower recovery. Year-on-year change has moved higher, but still remains in negative territory. Just to kind of put it into context that yes, sentiment has improved as it should, but it doesn't mean that you're going to snap back to positive. And again, we see this going more sideways than anything else. Now, when you look at a builder sentiment climb, sending back to the highest since July 2022, but the 6-month change showed the strongest on record if you're comparing it to pre-COVID, but again, still negative. So you're still seeing traffic has improved. People are looking around, but again, it is June. It is May. June is your key, July, August, you're in peak buying season, so you should see traffic improve. Not surprising. The question is, are you going to seeing people bite? And because the mortgage data that we showed you last week showed that a big decline. And we are at 10-year lows for new mortgage applications, which again, trying to balance this in general when you're looking at some of this underlying activity. So that's what we have on the U.S. front. The next segment, we're going to go into the East, the Europe, talk briefly about the UK and what are some of the pieces that are happening in the European theater.